BYD's third quarter results for 2025 are pointing to something much bigger than just a challenging quarter. What we're seeing is a fundamental inflection point for the company. The data reveals a forced move away from a growth model that served them for years. So today, we're going to deconstruct the pressures that are driving this strategic pivot and really explore what it means moving forward.
Okay, so here's our central thesis, right up front. BYD has been forced to abandon its very successful internal war, external supplement growth model. It's just not viable anymore. This has pushed the company into a new, much more defensive posture, and it's a direct response to intense pressures on both the domestic and international fronts.
And the evidence for this strategic shift? Well, it's unambiguous. You can see it written right there in the top-line financial data, which shows a pretty sharp deviation from the high-growth path BYD has been on for years. The headline figure that really grabs your attention is the 32.6% year-over-year drop in net profit. Now, a contraction of this size is a rare thing for BYD, especially in its recent high-growth phase, and it points directly to some severe underlying pressures on its ability to generate earnings. So where's that profit decline coming from? It's a direct result of significant margin compression. The company's gross margin shrank by 6.13 percentage points compared to last year. That's a clear signal that its pricing power is eroding. Now, if you take all these key metrics together, they tell a very cohesive story. You see a modest dip in revenue, but when you see it next to these steep drops in net profit, gross margin, and even operating cash flow, well, it paints a clear picture of a company facing systemic challenges right across its financial structure.
This financial deterioration is really stemming from pressure on two distinct yet interconnected fronts, and together they've effectively dismantled the dual-engine growth model that was fueling BYD's recent expansion.
You see, for a while now, BYD has operated on this very clever dual-engine model. The company could afford to sustain a really fierce price war in its home market, the internal war, because those lower-margin sales were basically subsidized by exceptionally high profit margins from its exports, especially to Europe. That was the external supplement. But now, the domestic front has turned into a brutal war of attrition. To defend its market share against a flood of competitors and to manage its rising inventory, BYD has been forced to sacrifice its margins. It's a classic price-for-volume strategy, and it has direct consequences for the bottom line. At the exact same time that external supplement engine, well, it's been neutralized. The introduction of significant anti-subsidy tariffs by the European Union is a direct hit on that high-profit buffer that was so central to the company's entire financial strategy.
And this slide really quantifies that new reality. A new 17% anti-subsidy tariff, and that's on top of the existing 10% import duty, fundamentally changes the economics of the European market. What was once a profit sanctuary where export prices could be much higher than at home has now become just another contested front.
So, faced with these pressures on both sides, what is BYD doing? The financial data shows us a very clear and very deliberate strategic pivot from management. The company's strategy has now shifted to what we're calling internal war, external defense. And this is a much more challenging phase, where both of its core markets are now competitive battlegrounds, requiring a ton of resources just to hold your ground.
And this, right here, might be the most telling data point of all. For the first 9 months of the year, BYD's investment in research and development far exceeded its net profit. Now, this isn't some cyclical anomaly. It's a clear strategic choice to prioritize long-term technological superiority over short-term financial returns.
So you have to understand, this huge R&D expenditure is a high-stakes bet. The goal here is to build a technological moat, an advantage in core components like batteries and intelligent driving systems that's so significant it just can't be easily copied by competitors. The aim is to secure a dominant long-term position. So, as we look forward, how do we track the success of this new strategy? Well, it means we have to shift our focus. Analysts need to look beyond pure sales growth and start watching a new set of indicators that measure strategic resilience and technological progress.
This table really lays out that domestic battlefield for you. Across every single core market segment, from its mass market base all the way up to its premium offerings, BYD is now facing intense, targeted competition from a full spectrum of rivals.
So, with all that in mind, these are the key forward-looking indicators we need to watch. We'll be monitoring for gross margin stabilization, Can it hold at this level? We'll be watching overseas performance post-tariff, inventory management, how the new models are received, and critically, progress on building out its global manufacturing footprint to get around future trade risks.
And all of this brings us to the central strategic question. And it's not just for BYD, it's for the entire industry. In a world defined by intense domestic competition and rising global trade barriers, can massive investment in technology actually create a truly sustainable global market leadership position? That is the question the market will be watching.